Imagine walking into your bank and discovering there's an account that earns more interest than a normal savings account, still lets you access your money, and comes with almost no risk. Sounds too good to be true, right? Well, that's exactly what money market accounts promise. But here's the real question. How do money market accounts actually make you money? And are they really as safe and profitable as they sound? Stick around, because by the end of this video, you'll know exactly how these accounts work, who should use them, and how to make the most out of one. Number 1. The basics of a money market account. Let's start simple. A money market account is like the cousin of your regular savings account, but with a few upgrades. It's offered by banks and credit unions, and it pays interest, sometimes much higher than your basic savings account. Now, many beginners get confused because money market account sounds a lot like money market fund. These two are not the same. A money market fund is an investment, usually found in your brokerage account, where your money goes into short-term government or corporate debt. A money market account, on the other hand, is a deposit account that's insured by the FDIC or NCUA, meaning your money is protected up to $250,000. So, in short, a money market account is a savings tool with a higher earning potential and low risk. It's like giving your money a slightly more comfortable home without sending it off to Wall Street. Number 2. The secret behind how they pay you interest. Here's where things get interesting. Banks don't just give you higher interest rates because they're feeling generous. They actually use your deposited money to make short-term loans, invest in low-risk securities, or fund other bank operations. When the bank earns money from those investments, it shares a piece of the profit with you in the form of interest. That's why the interest rate on a money market account can fluctuate. It's tied to broader market conditions. For example, when the Federal Reserve raises interest rates, banks can earn more from their investments. So they often raise the rates they pay to money market account holders. That's why during high-rate periods, like in 2025, many banks are offering over 4 or even 5% annual yields on these accounts. Number 3. How interest in a money market account actually works. Most money market accounts calculate interest daily and pay it monthly. That means every day your balance earns a bit of interest, and that interest compounds, meaning you earn interest on your interest. Let's say you deposit $10,000 in a money market account with a 5% annual yield. After 1 year, you'd earn roughly $500 in interest. But because of daily compounding, you actually make a bit more than that. Here's a quick example. Imagine you start with $10,000. Each day, the bank adds a tiny bit of interest to your balance, just a few cents at first. But as your balance grows, those cents turn into dollars, and those dollars start earning more dollars. Over time, this compounding effect quietly builds your wealth without you doing a thing. That's the beauty of it. Your money works for you, even when you're asleep. Number 4. The big advantage: safety and flexibility. One of the biggest selling points of money market accounts is safety. Unlike investments that can lose value, your money in a money market account is federally insured. That means even if your bank somehow goes under, you're still protected up to $250,000. It's as close to no risk as it gets in the financial world. But safety isn't the only advantage. Money market accounts also offer flexibility. Most allow you to write a few checks per month or use a debit card for withdrawals. That makes it more convenient than locking your money into a certificate of deposit or CD, which typically penalizes you for early withdrawals. Imagine needing quick access to your emergency fund. With a money market account, you can transfer money instantly or even use your debit card to cover unexpected expenses without missing out on higher interest. Number 5. How banks compete for your money. Here's something many people don't realize. Banks are in constant competition for your deposits. When they want to attract more customers, they often raise their money market rates. That's why you'll see some banks offering 2%, while others go as high as 5% or more. Online banks are especially known for offering better rates because they don't have to pay for physical branches. Let's say a big traditional bank offers 2%, but an online bank offers 5% on the same type of account. If you keep $20,000 in there for a year, that's a difference of $600 in earnings just for choosing the right bank. So the lesson here? Always compare before opening an account. Number 6. Common requirements and restrictions. Before you rush to open a money market account, it's important to know the fine print. Some banks require a minimum deposit, sometimes $1,000, sometimes as high as $10,000. If your balance falls below that, you could lose your high rate or even face a monthly maintenance fee. And while money market accounts allow some check writing or transfers, federal regulations often limit you to 6 withdrawals per month. Go over that limit, and you might get hit with a fee or even have your account converted to a regular checking account. Here's a quick example. Suppose you open a money market account with a $5,000 minimum balance. You earn 4.5% interest, but one month, you withdraw too much and your balance drops to $3,000. The next month, your interest rate might drop, or worse, you pay a $10 monthly fee. So always read the terms before signing up. Number 7. Who should actually use a money market account? Money market accounts are not for everyone. They're perfect for people who want to earn more interest than a regular savings account without taking investment risks. If you're saving for something short-term, like a vacation, a new car, or an emergency fund, it's a great choice. But if you're trying to grow your wealth faster over the long term, like for retirement, you'll probably earn more from investing in stocks or index funds. Think of it this way. A money market account is like a comfortable parking spot for your cash while you decide what to do next. It's not the racetrack, it's the safe zone. For example, if you just sold your car and have $15,000 you won't need for a few months, parking it in a money market account can earn you around $50 to $60 in interest instead of letting it sit idle in a checking account that earns nothing. Number 8. The hidden downsides you should know. Now, let's be honest. Money market accounts aren't perfect. The biggest downside is inflation. If inflation is 4% and your account earns 4%, your real purchasing power hasn't grown. It's just keeping up. Another issue. Variable rates. Banks can lower your interest rate anytime, especially if the Federal Reserve cuts rates. And finally, access limitations. Even though you can write checks or use a debit card, some accounts still have monthly limits. It's not quite as flexible as a checking account. Still, these downsides are small compared to the security and returns they offer, especially for short-term savings. Number 9. How to find the best money market account. If you're ready to open one, here's what to look for. First, compare interest rates. Sites like Bankrate or NerdWallet often show up-to-date lists of the best rates across the country. Second, check for minimum balance requirements. You don't want to tie up more money than you can afford just to avoid a fee. Third, make sure your account is insured by the FDIC or NCUA. That's your safety net. And finally, look for extra perks, like mobile banking, check writing, and free transfers. For example, some online banks offer 5% APY with 0 monthly fees and no minimum balance. That's the sweet spot for beginners. Number 10. How to maximize your earnings. Once you open your account, there are a few smart ways to earn even more. Keep your balance steady or growing. Since most accounts calculate interest daily, a higher daily balance equals more earnings. Set up automatic transfers from your checking account to your money market account every month. Even $100 a month adds up quickly thanks to compounding. And finally, stay informed. Interest rates can change fast. If your rate drops significantly, don't be afraid to move your money to another bank. Your money deserves the best possible home. Let's take an example. Suppose you put $10,000 in a 4% account and keep it there for 5 years without adding a dime. You'll end up with about $12,166. But if you move that same money to a 5% account, you'll have about $12,763. That's nearly $600 more just for switching. That's the power of staying alert. Number 11. How money market accounts compare to other options. You might be wondering, why not just put my money in a savings account, or maybe even a certificate of deposit? Savings accounts are easier to open, but their interest rates are usually lower. Certificates of deposit often have higher rates, but lock your money for months or years. Money market accounts sit right in between. You get better rates than savings accounts, but you keep some flexibility to withdraw your money. Imagine you're building an emergency fund. You want it to earn good interest, but still be available in case of a job loss or medical bill. That's where a money market account fits perfectly. Number 12. The psychology behind it. Why they work so well. Here's a fun fact. One reason money market accounts help people save is psychological. When your money is earning visible interest, you're less likely to spend it. You see that balance growing, and you want to protect it. It turns saving into a small, rewarding game. Some people even open separate money market accounts for specific goals, like vacation fund or home down payment fund. Each month, watching that balance grow keeps them motivated. It's a powerful, simple trick that turns passive saving into active progress. Number 13. How money market accounts react to economic changes. One interesting thing about money market accounts is how they respond to the economy. When interest rates rise across the country, banks and credit unions often increase the rates on money market accounts to stay competitive. But when the Federal Reserve lowers rates, your money market yield usually drops too. This means your earnings depend a lot on the overall financial climate. For example, during high inflation periods when the Federal Reserve raises rates, money market accounts can become very attractive compared to regular savings accounts. It's smart to pay attention to these cycles because timing your deposits can make a big difference in how much you earn. If you open an account when rates are climbing, you'll likely lock in higher earnings for a while. Number 14. The role of money market accounts in an emergency fund. A lot of financial experts recommend keeping your emergency fund in a money market account. The reason is simple. You earn more interest than a regular savings account, but you can still access your cash when life throws a curveball. Let's say your car suddenly breaks down, or you have a medical bill to pay. Instead of dipping into risky investments or swiping a credit card, you can just pull from your money market account. It keeps your emergency fund liquid, safe, and still growing little by little. That's why many people see it as the perfect middle ground between safety and reward. Number 15. How money market accounts can support short-term goals. Money market accounts are ideal for short-term financial goals. Maybe you're saving for a wedding, a new laptop, or a family vacation next summer. Instead of letting that money sit in a low-yield checking account, you can put it in a money market account and watch it grow while you wait. The best part is you can still withdraw the money when your goal date arrives, with no penalty. For instance, if you're saving $5,000 for a vacation, a money market account paying 5% could earn you over $200 in a year, enough to cover your travel insurance or part of your flights. It's a simple and smart way to make your short-term dreams come true faster. Number 16. How businesses use money market accounts. Money market accounts aren't just for individuals. Small businesses use them too. They're a great place for companies to store cash reserves or funds set aside for future expenses. Because these accounts earn higher interest, businesses can make their idle cash work harder. For example, a local cafe might keep its extra $50,000 in a business money market account and earn over $2,000 a year in interest without lifting a finger. It's a low-risk way for small business owners to grow their safety cushion while maintaining access to cash when they need it. Number 17. How money market accounts compare to high-yield savings accounts. At first glance, money market accounts and high-yield savings accounts might look the same. But there are key differences. Money market accounts often come with check writing privileges or debit card access, while high-yield savings accounts usually don't. On the other hand, high-yield savings accounts sometimes offer better rates and require lower balances. The right choice depends on your goals. If you need more flexibility for spending, go with a money market account. If you only care about maximizing returns and won't touch the money, a high-yield savings account might be slightly better. Both are great for growing your savings safely. Number 18. How taxes affect your earnings. It's important to remember that the interest you earn from a money market account is taxable income. That means at the end of the year, your bank will send you a statement showing how much interest you earned, and you'll need to report it when you file your taxes. For example, if you earned $400 in interest, that amount gets added to your total income for the year. The good news is that because money market accounts are so safe, they're still worth it even after taxes. You can also use them alongside tax-advantaged accounts like IRAs for a more balanced financial strategy. Number 19. How to automate your savings with a money market account. Automation is one of the easiest ways to grow your money without effort. You can set up an automatic transfer from your checking account to your money market account every payday. Even if it's just $50 or $100 a month, it adds up fast thanks to compounding interest. This approach also helps you build the habit of saving without even thinking about it. It's like paying yourself first, automatically. For example, if you transfer $100 every month into a 5% account, you could have around $6,800 in 5 years. without ever making a big deposit. That's the quiet power of automation and consistency. Number 20. Why money market accounts are great during market uncertainty. When the stock market gets shaky, many investors move their cash into money market accounts. These accounts act as a safe shelter while markets recover. Because they're insured and earn steady interest, you can wait out market volatility without worrying about losing value. For example, during financial downturns, cautious investors often pull their funds from stocks and park them in money market accounts until conditions improve. It's a defensive move that protects your wealth and keeps it growing slowly but surely. If you want peace of mind during uncertain times, money market accounts are a smart temporary home for your money. Money market accounts are one of the rare tools in personal finance that reward both safety and discipline. They don't make you rich overnight, but they quietly grow your money in the background while keeping it completely accessible. So the next time you're deciding where to park your savings, think about this. Would you rather have your money just sitting or working quietly to earn you more every single day? What would you personally use a money market account for? An emergency fund, a vacation, or maybe a down payment on your dream home? Let me know in the comments below.